Well, hello again, everyone. Here is Chapter 16, Capital Structure and Leverage. This chapter isn't as long as it could be in that the M&M, Modeliani, and Miller is interesting. Feel free to breeze through it, but that's not something that I plan to test on. It's an interesting theory that isn't particularly practical. In the end, a lot like Black-Scholes, it has a lot of assumptions associated with it, and it doesn't have a lot of real practical usage in a way that you would find if you were doing a theoretical finance degree. By all means, I'd go into it, but you're not. So feel free to breeze through that part, and as such, we'll be breezing through it on the slides as well. So we'll talk a bit about the background, financial leverage, the impact of leverage on certain ratios, briefly operating leverage, and briefly capital structure theory. So basically, capital structure is the mix of firms' debt and equity. So, what percentage is debt, what percentage is equity. Preferred shares could be treated as part of firm's debt. It depends on the company. This textbook, again, is making a blanket assertion that preferred shares should be treated as part of a firm's debt. In some companies, in some industries, preferred shares are treated as a separate component of the capital structure, and you consider the three elements of capital structure as common shares, preferred shares, and debts. But in this particular text, they lump in the preferred shares with debt notionally, so that's how they treat it. Now, financial leverage. The idea of financial leverage is simply to take on debt, to use that debt to generate more sales and therefore more margin, so you can increase your earnings per share. Remember that when we calculate earnings per share, we're taking the earnings divided by the number of shares outstanding. So if we can rely more heavily on debt and less heavily on issuing shares, we decrease that denominator. We don't have as many shares outstanding, so we can amplify the earnings per share in a way that makes us maybe more competitive in terms of our earnings per share looks better than a competitor's because we have more debt and less shares as part of our capital structure. So leverage-related risk is the variation in the return on equity and the earnings per share. There's two components. One is business risk, which is how much profit is basically being generated by the company. EBIT stands for earnings before interest and taxes. So it's about so taxes are something that just happen. They have nothing to do with the company as far as whether they're more or less. And interest is about financing, not about operating. So that's why we look at EBIT, where we're sort of removing those two things from the calculation. Financial risk is about, okay, well, now that we've taken on more debt, what does that mean in terms of our ability to service the organization, to service the debt, and also generate a return on equity? So, financial leverage, the more debt that you take on, can improve the firm's EPS and ROE, right? Because if you're taking on fewer shares, you're adjusting that denominator there, and fewer shares, greater value for the company overall means greater value per share as well. And the key thing about financial leverage or debt is that it is a magnifier. If things are good, it's positive reinforcement. It makes things look even better. But if things are bad, so it says here on the slide, however, at other times it lowers EPS and ROE. When things aren't good, when margins aren't healthy, when sales aren't healthy, it tends to have a very bad effect on earnings per share and ROE. Why? Because interest payments, for example, are factored into income, and so when we look at earnings per share, if we have very low profits and some of that's getting eaten up by interest, if interest rates are high and they've shifted somehow, we've got lower earnings basically. So it's one of those things that's a double-edged sword. Financial leverage is a double-edged sword. It increases risk overall. So as I said, financial leverage is a two-edged sword. Good results look great and bad results look terrible. And financial risk is increased variability in the financial results. So in other words, because we have this magnifying effect, we have more financial risk when we have more debt. So leverage enhances performance while it adds risk. So it can drive the share price up and down if it's the wrong amount. So let's take a look. The idea is to have the right amount of leverage, the optimal capital structure, sort of the perfect amount of debt and the perfect amount of equity, and hit that sort of top line for share price, that top point on the curve. Now, we can draw this little graph and it looks really pretty, but how do we actually find this? Well, it's one of those notional concepts rather than something where there's a precise mathematical formula to help us find it. Let's talk more about that. So there's no way to determine the exact optimum amount of leverage because it varies by business and it varies. In addition to nature of company's business, it's the industry itself. The industry itself will have norms around who is being more risky and who is less risky and what the appropriate bounds are for the percentage of debt in the capital structure. And the economic climate also has a huge impact because when times are good, more and debt is cheap, more debt is good. But when debt is expensive or things look not so good in the future, then a lot of debt looks really, really risky and really, really bad and will have a negative impact on earnings. So there's the industry and the business itself, and then there's the economic climate, and both of these things have an impact on how much debt is the right amount of debt or optimal amount of debt. So, general guidelines. A profitable firm with little or no debt should probably have some. Apple went out and issued their first dividends, and they went out and got debt to do it because debt was cheap. So they had no debt, and now they have some debt, and it's pretty cheap, and the interest rates are really, really low. They may have even repaid it by now with such a small amount. So for most businesses, the optimal capital structure is somewhere between 30 to 50% debt, depending on the industry. And debt levels above 60% create excessive risk unless it's in a particular industry, in this case, a public utility. It knows what its incoming revenues are going to be. It knows what its costs are because they're predominantly fixed. So a public utility can certainly have a fair amount of risk and a fair amount of, therefore, debt. So terminology and definitions. The operating leverage refers to the amount of fixed costs in a cost structure. The higher the fixed costs, the more business risk there is because you need to generate more sales to get the margins to cover the fixed costs. And you can use a break-even analysis to figure out exactly what kind of sales efforts are needed to cover those fixed costs. So what kind of break-even would we need in product or in service in order to cover the fixed costs in this area of the company or in the company overall? So here's an example. We can do it on a unit level or we can do it on a sales dollar level. So for a very simple company that doesn't have a lot going on as far as different products or services, we could say, okay, well, if we have a certain amount of fixed costs, say we've got $100,000 in fixed costs, and we're selling something that's like a B2B, very expensive piece of equipment that has a $20,000 contribution margin. Contribution margin, you'll remember back to accounting, is your revenue minus your variable costs. So if your variable profit, so to speak, if your contribution margin is $20,000 per unit, you have $100,000 in fixed costs, then selling 5 units will cover your fixed costs and is therefore your break-even point in units. So that's the simple calculation that you would do for break-even levels. And for sales dollars, you're just using the dollar amounts as opposed to the unit amounts for the margin. So you'll notice the denominator is exactly the same, but the break-even is the sort of price of the fixed costs, I guess is a better way of putting it. So how does this work for a company like TELUS? Well, it means that when you're looking at different parts of the organization, you can do some approximations of things like, how many handsets do we have to sell on average, considering an average revenue and average variable cost per headset and an average cost of running a retail location, for example. How many does it need to run? Or maybe small, medium, and large retail locations, we need this kind of break-even units in terms of handsets at each of those. For services parts of the organization, it might be in the number of services that are done, the number of new signups that are done, the number of customers that are retained, and other areas. So we've got these nice little formulas here, but it's much more difficult to actually use this in industry, particularly in a company like TELUS where there's a fair amount of complexity. So Here's an example of a calculation that can be done to figure out break-even sales levels. So we've got a $10 per, that's the price basically of this item, and we take $7 in variable cost to produce it, which means that we make $3 per unit in contribution margin. So if we have $1,800 in fixed costs, $1,800 divided by 3 tells us that 600 units is where we would have to get to break even. And if we multiply that by our $10,000 that we sell them at per unit, we get $6,000 for our break even sales dollars amount. Now, Modigliani and Miller, so this is sort of the last slide. I just wanted to touch on that briefly, and feel free to go through it in more detail in your textbook. Basically, the Modigliani and Miller was sort of capital structure, does it have an impact on stock prices? And in the end, after you kind of read through all of the information on that, you'll find that they've come to the conclusion that capital structure, in fact, does impact stock prices. And there is such a thing as an optimal capital structure, but there's no precise way to find it. And one of the things that makes it so hard to find is the dynamic nature of industry, and for that matter, global economics. So as things change, the optimal capital structure would also have to change. As debt gets more expensive, less is more. As debt gets cheaper, more is more, right? Just as an example, when there's a lot of uncertainty, less is more. When things are really stable, more is more. So considering all of these things, there's a consensus though. The nice thing for a company like TELUS is that smart people internally and externally are always thinking about this, about what the optimal capital structure should be, what's acceptable in the industry and what's not. And sometimes companies like TELUS or others push the boundaries of that and get some feedback from the market, and that's how things change over time. So that's it on chapter 16.